Personal finance presentation, financial goals. Prepare to get financially fit by practicing personal finance. Like with anything we're trying to achieve, setting goals is going to be a major strategy that we will implement and a skill worth learning, both with regards to personal finances and one which we can apply to many other things, just about anything when we're trying to improve on it. One of the examples often given for setting goals is some kind of physical fitness strategy or goal. In other words, if someone was just simply to say, I want to be more physically fit, they're probably going to have less progress than if they were to map out the goal in a more thorough way. Even if they don't exactly follow the map precisely at the start, they get some idea of where they're going and the direction they're on, that more information typically being useful so that they can continue to improve from that point forward. The same is going to be true with financial goals. If we set the goals, if we have a target that we're going to be shooting for, even if we don't hit the target, at least we have some kind of idea to measure to what we thought was going to happen. So even if we are wildly off, we at least have a better perspective of where we are, so that that better perspective can help us to make better goals and then continue the process. So like with anything, the general idea being we're going to project out, we're going to try to think what's going to happen in the future, what we can achieve in the future. We're then going to go through the process and do it, and then we're going to see whether or not we met our expectations, and then try to refine down our expectations and then repeat the process. So it's useful to set our financial goals up into some kind of categorizations. When you hear just simply setting goals, then it seems kind of vague and mundane, and you'll end up coming up with goals that are completely broad, like I want to have like no debt or something like that, or I want to be financially independent. These are good goals, but they're not really specific, and what you want to do is get them to be more specific, and we'll talk more about the SMART goals so that you can measure them. One way to kind of categorize the goals first is by time frame. So you might first say that I want to have short-term goals. Those are going to be things that I want to achieve in the next year or so. You may then have the intermediate goals, which are going to be like 2 to 5 years out, and then long-term goals, which are over 5 years out. Clearly, these are arbitrary categories. We just basically picked a line in the sand and drew a line and said, I'm going to have these short-term, mid-range, and long-term goals. But that can be useful to help you to categorize where you have specific items. So for example, in the short-term category, if we're talking short-term goal, things that are going to be less than a year, we might have something like a vacation that we're planning in the short term. We might have something like pay off small debts that we would like to achieve within the next year. We might have budgetary objectives that we're planning for to try to see what our behavior is from a financial spending perspective within the next year, our yearly budgets or our monthly type of budget planning. When we think about the intermediate goals, this will be dependent in our particular circumstances, but when we're thinking about goals that are going to be like 5-year out type of goals, then we might have, say, a home purchase, depending on our current conditions, as a goal that would be within that range. We might have other debts that we're trying to pay off within that range, possibly like student loan debts, or to pay off a car loan or something like that we would like to pay off within that range. We might then have a new car that we would like to purchase at some time. Note that when you're thinking about a car, it's almost always in that intermediate range, because the car lasts, 5 to 10 years, or how many cars are you going to need at one time within the household. So you might have a car somewhere within there that you're going to be needing at some point in time, just in the nature of the way cars are going to work. And then we've got the career goals, which might be something that you're planning on an intermediate side in terms of what you think your revenue objectives will be with regards to your career goals as well. And then we've got the long-term goals, and those could include things. Pretty much everybody will have basically a retirement plan type of goal. That's going to be one of the most long-term kind of things. These are things that we arbitrarily put here over the 5-year time period. For retirement, when you're thinking about financial objectives, that's one of the longer-term plans that you can have within your life. Then, of course, you can plan with a past your life, which would be things like estate planning. Note that as we go to the long-term goals, the longer the goals that we're looking at, then the more we have to kind of take a systematic look at what we are doing. In other words, when we take the day-to-day type of goals and our budgetary habits, then we got to think about our habits, which those are difficult to break, but we want to think about them on a day-to-day type of basis. And usually our day-to-day activities are pretty good. Once we have the baseline set up, the habits are usually good. That if we have good habits, then those are going to be usually good, and our short-term decisions are usually good. Our immediate to long-term decisions are often not good by nature if we don't hone down some specific skills, meaning saving for retirement means that we're delaying gratification for like 30 years, saving money for a long period of time to benefit the future. Our brains are not wired to do that. So that's when we have to do more of the long-term planning. And if you compare this to like a business type of perspective, just realize you're doing a similar kind of process. If you look at the business side of things, you've got different people doing different things. The top management is usually doing the long-term type of goal planning. Do I want to grow? Do we want to have another department that's going to be included? And so on. And when you have the management of the smaller management, the mid-management and the lower management, they're usually more on the day-to-day type of things, running the day-to-day types of things where they might be able to run after a while more on habit, more on kind of like instincts. You got the same kind of thing here, but you're doing everything with regards to you, this one entity, which has both short-term needs and long-term needs. You might have then the children's college, which could be something that could be long-term. That might be falling within the 5-year range, depends on where your children are at that point in time. Vacation home, you might be saying, I want to save up for a vacation home, which again, that could be a long-term thing that you might be thinking outside to have the vacation home. So those are just some examples that you can group together. Clearly, your personal examples will differ based on your unique circumstances, but categorizing by time frame and just arbitrarily picking those time frames 1 year out, typically that you're focused on the behavioral changes that you might want to make from a day-to-day basis, which can adjust your budgetary spending and whatnot. The midpoint, meaning what do I need to purchase that's kind of outside the range, usually things that don't happen on a day-to-day basis, like a car or something like that. And then the long term, which of course typically would be including the retirement and things like college savings and things like that. Now you can also break your budgetary items up. Instead of simply by range, you can have the financial needs, what your financial needs are. This is probably a little bit less common, and when you think about the financial needs, they kind of line up in essence to your budgetary needs in terms of your time frames that we talked about as well. But you could think about consumable, those are your product goals, durable product goals, and intangible purchase goals. This is another way that you might categorize your spending so that you can better measure what you're doing and make goals. So the consumables could represent things like they usually occur on a periodic basis and involve items that are used up relatively quickly. So these probably will line up then when you're looking at your time frame goals to things that are going to be within the year time frame, because they're things that you're going to be purchasing fairly often. Things like food, things like clothing, things like entertainment. So then we have the durable product goals. So those are usually involve frequently purchased expensive items, infrequently purchased expensive type of items. So these probably are going to line up closely to your mid-range goals. Those are going to be things like a car, things like the sporting equipment. These aren't things that you're buying, of course, all the time. These are things that you're probably going to be saving up for. And so you might want to think about it in these terms as well, right? You might want to say, well, what are those intermediate things? They're going to be lasting longer. The durable product type of goals could be a boat or something like that. And then we have the intangible purchase goals. Those could be things that could include like personal relationship type goals. Intangible, in essence, means that they're not things that you actually physically own. They're not actual things. They're intangible types of things. So when you think about relationships, you could think about restaurants and trips and that kind of thing, the day-to-day kind of intangible type of purchases, which might then be in your normal kind of budgeting, which you might put in a time frame goal within like a 1 year type of thing. The health, so if you have things like a fitness gym and stuff like that, it's intangible in that it's not a physical thing, but obviously it's could be in your budget as well. It might be falling into the short-term time range. Things like education books and whatnot might fall into something that's intangible if you're talking about at least audiobooks and things like that. Community service and leisure. So then when you think about the goals, then of course you want to set up the goals in such a way that they're going to be in accordance with something that you can measure. Oftentimes this is shown with SMART goals. So SMART is the acronym that we would be using. That means they want to be specific. So when you set up a goal, for example, if you're doing budgetary goals, if you set up the goal to say, I just want to spend less, well, that's not very specific. You don't, I mean, that's a good goal and that it would be nice if you could spend less, but it's not, you don't know how to do it. So if you go line by line through your budget, meaning taking your accounting records based on the past data, that's why that would be important. And then you can look at the line items and say, well, maybe I can spend less on, say, sit-down restaurants. Maybe I spend a lot of money going out to eat a lot. Maybe that particular line item I spend less on. And then you can actually pinpoint that particular thing, whatever that particular thing is that you want to meet. You want it to be measurable. So once again, if it's something that you can't, that isn't something that you can measure, then you can't really judge whether or not you did well on it. If you're using vague language with yourself, or if someone else is using vague language, it's often difficult to actually pin down what we want. If the goal is to say, I want to spend my money better or something like that, well, I want to spend my money in a fair way. And then politicians, they always use the word fair. I want to make a policy that's fair, and fair mean, well, what does that mean, right? That's not very measurable. That's not very specific. So what you'd like to do, and in this case, if you were specific, you'd say, I'm going to spend less. Then you can basically measure how much you spent last time on the restaurants, possibly, and then be able to measure in the future because you're tracking with some kind of accounting records what you're measuring in the current month, and then you can compare and contrast what you specifically line item said you wanted to do versus what you actually did during that time frame. It needs to be something that's achievable. This is often one of the most difficult kind of components because when you're thinking about goals, it's always, you don't want to set the bar too high and you don't want to set the bar too low. It's the same thing if you're doing managing of other people as with managing of yourself. If you set the bar too high, if you're saying, I want to spend $0 next month and save all my money, I'm just going to not spend any money. Well, that's not, that's not going to happen. That's not going to be achievable. And if it's not achievable, then you're never going to feel like you did a good job, and therefore you might just give up at some point, right? But if the bar is too low, then you have the problem of well, that was easy to clear, such an easy thing to clear that it wasn't even a challenge, and that's disincentivizing as well. So what you want is the bar to be just above what you think you can possibly do, just a little above there, so that you can over and surpass your expectations. That's kind of what you're looking for. That's difficult, of course, to do, is to set that bar to a place where it's not discouraging you on the one level, and at the same time, it's not something that you're clearing so easily that you're not even getting it. You should get some satisfaction from clearing the goal. You should be able to say, that was good. I did a great thing, right? It shouldn't be something where the guy that jumps over the bar just walked over the bar, and it's not very exciting that way. It should be relevant, so it's got to fit into your overall plan, which seems kind of obvious, but it makes sense, right? That if your goal is to lower your spending, for example, in our budgetary example, and then you had one specific goal that you're going to spend as much as possible as you can in a particular restaurant then obviously that doesn't make. Why would that be the case? That goal doesn't fit. You're within your overall strategy to lower your spending, to spend more money on a particular thing, right? I mean, the goal has to fit in there, and you would think that would be kind of obvious, but sometimes there can be a mismatch, and so you want to keep that in mind. It has to be time based. So if you're saying, I want to spend less money in our budgetary goal, I want to spend less money on this thing than on restaurants, the specific restaurants, then you want to make that for the next month or the next week or something like that, so that you can actually measure it. And you want to be able to compare it then to the prior month, so that you can have a comparison. To do that, you need a time-based measure. And note that when we're thinking about personal finances, we're always thinking within time. We're thinking about how are we doing over time. So when you think about the general financial statements, it's usually the balance sheet is where we stand as of a point in time. Those are our assets and those are our liabilities. The income statement is our performance in the past, meaning income and expenses, how we did for the last month, last year. And then in the future, we're thinking, what are we going to do over the next time frame? And you have to have the time frame in order to set the goal. So what am I going to do in the next month? How can I measure what I'm going to do in the next month? How can I judge my performance, in that next time frame? And then when you're doing the longer term time frames, then of course you want to possibly cut them down into smaller chunks and see how, is your investment growing the way it should be growing, the way you planned it to be growing, in order to meet your 5-year objective of buying a new car, to get enough money to buy a new car, and that kind of thing. It's always the same process with these type of things when we're trying to improve. And the better results will typically be, we're going to set an objective. We're going to make sure that objective is as specific as possible, so I can say, this is it. I'm not saying I'm going to make something good. I'm going to make something better. This is actually what it's measurable, meaning I can actually say, I know when I met that goal, because I can compare it to what I did before. It's not just a vague term like I'm going to make my accounting more fair, or so I'm going to make my accounting, more better, or something like that. And it's got to be achievable, meaning don't set the bar too high or low. It needs to be relevant. All your goals should line up to your ultimate goal. If you think about that in terms of your business strategies, businesses typically have an overall mission, which is driving their whole strategy, supposedly. And you should have a similar kind of process. And then all your goals should be lined up and be in accordance with the overall mission. And if they're not, then you want to kind of go in there. And then, of course, time-based, because we measure things over time. If you're trying to see how performance is, you measure over time. And then you just repeat the process over and over and over again, just like someone at a gym would do, right? That's what they're going to do. They're going to say, there's my performance. Did I hit the performance? How am I going to improve it? And then you do it again, and then you do it again. So opportunity cost is a key concept when you're thinking about finance. And it's an economic concept. So this is one of those overlapping terms that comes from basically economics. And it's often said, the accounting records show your financial data. And when you think about opportunity cost, you're taking into consideration not just your financial data, but also your other desires and whatnot within your overall mission, right, of your personal mission. So it's going to be what you give up when making a choice. And this is the idea behind the idea that nothing is free. Nothing is free. Even if someone gives you free tickets to a concert or something like that, even though the tickets are free, you still go into the concert, you're giving up your time to go to the concert. It might be well worth it because you might have nothing better to do at that point, but you're not doing whatever else. You're not going to the beach if you're going to the concert. You're not reading a book if you're going to the concert. That's the opportunity cost. There's always a cost because you're giving up with your time, at the very least, what you could have done somewhere else. So that's how you want to think about any kind of decision. If you start thinking about them in those terms, it can kind of be useful, because if someone's saying to you, do this or do that, it doesn't cost you anything, then that's not really true, right? You really want to be like, well, it is kind of costing me something. What is it costing me? I might be willing to do that, but I mean, you want to know, you want to basically put down what the actual costs are. So it's going to be the trade-off of the next best choice. That's often how it's phrased. So whatever you chose to do from an economic standpoint is your highest choice because you chose to do it. And that means that whatever you would have chosen to do, secondly, would be the thing that you gave up in order to do the thing that you chose to do. It's not always measurable in dollars, although we can think about it in dollar terms. You need to consider both personal and financial resources when you consider this. So if you look at a personal opportunity cost, that's one concept that we might try to pull out the dollars from and just think about it from a non-dollar standpoint, and that often has to do with time. The time used to do one thing cannot be used to do another thing. So for example, if you're studying, or go to the beach, you can't really do the two at the same time. You can't study and go to the beach. You could, but let's be honest, your study time at the beach probably is not going to be as good as home. So you can do multitasking. Multitasking is a thing, but if you're not chewing gum and walking or doing two things that are physically taking different parts of your body, then it's going to be difficult to do that. If you're trying to relax your mind and stimulate your mind at the same time, those are two opposite things that you're trying to do to your mind. That's kind of difficult. So in any case, that's going to be the opportunity cost. You can say, should I work or should I go shopping? Obviously, you can't do generally those two things at the same time. You could try, but generally doesn't work out too well usually. And then we got the financial opportunity cost, which is going to be something that's critical when you think about time value of money, which we'll get into a lot shortly. So would you rather have $100 today or $110 a year from now is going to be the typical idea. And the idea here is, of course, you have to measure out or balance what you're going to spend today, your current consumption versus your consumption in the future. Meaning, if I can put my dollar away today and generate more revenue from my earnings tomorrow, how much do I want to do that? Obviously, I want to spend money today. That's fine, but I also want to be able to have the money in the future for the things that I want to do as well. So that balancing act between money today and money in the future is a really important concept, and it's quite confusing given the fact that it involves delayed gratification, which is something that we are not intuitively good at as human beings, and it involves time value of money concepts and growth of money concepts and whatnot, which is as well as things like devaluation of money concepts, which are all things that are fairly abstract kind of concepts to take into consideration. And they'll usually have a timing element to them, and we'll work many problems with this kind of idea, but that's the opportunity cost of the dollar. Usually, if someone, for example, was to give us $1 today versus $1 tomorrow, we would normally want the dollar today, all else equal, because if I had the dollar today, I could either spend it, which I would get the immediate gratification for it as opposed to postponing it, and I can put it away. I can put it somewhere and have it grow. So theoretically, if I was able to put my dollar in stocks or bonds, then I can make it grow to $2 or something like that at some point in the future. Whereas if you just gave me $1 in the future, then I don't have the opportunity to either consume it, getting gratification now from it, or to invest it, hopefully allowing it to grow. Now, the other problem with that, of course, is that the dollar actually decreases in value over time. We call that inflation, meaning $1 today purchases less money tomorrow. So you also have to deal with that fact when you're thinking about it. When I get my dollar today, if I was to invest it, I would need to make an earnings of it over the inflation rate in order for it to grow so that it would actually have more purchasing power in the future than it has today. So we'll talk more about that with regards to time value of money.